This is Market Day Report. We're glad you're with us here as we get the morning going, and we've been trading now for about 45 minutes. Where's the corn market? Anybody finding the corn market? Well, the bulls aren't finding it at this point. It's been very bearish. 410.5. It's down 3.5 cents. You know, this market is actually down 33% from where we were 3 years ago today. Even just looking at today and backing up to January 1st. So year to date, corn market is 10% lower. Well, it's not performed much better. Beans have been down 33% over the past 3 years, though we are seeing a tick higher now. Make it 4 ticks higher or a penny higher for the November at 10.12.5. Wheat market taking it on the chin as September drops 9.5 to 5.29 a bushel. Hard red is also struggling, down 7 at 5.19. Spring wheat contracts now lower across the board, and the cotton market, cotton down 34% over the past 3 years. And December off 56 points, 67.78. Chris Swift is with Swift Trading in the studio with us. And Chris, not a whole lot going on, but we have seen some demand and some bullishness, if you will, for bean oil. Does that tie back over to the energy markets? Can we tie all this together?
I believe so. When we look at things right now, we're looking at the energy market because it has had a big move up since the first of the year. It got knocked down really quick when we did the bombing of Iran. That took the wind out from underneath the sails, and then it has consolidated since then. On Friday, we closed right on the low and at the bottom end of that congestion band, and then by Monday afternoon, we were already back at the top of it, and this morning, trading higher, we're through it. So now it looks like that the path of least resistance has now gone to the upside. With that new energy aspect up there, we think more inflation probably coming. We know that trade deals with Europe have been made, with Japan have been made, and here in the U.S., employment has been higher. Most everything kind of points towards more inflationary aspect than it does recession, and you get a little bit higher energy prices, and it really does start to take off and begin to hamper that consumer a little bit more.
And at the same time, you mentioned this. How about the dollar? Because the dollar's going to tie into this as well.
And made new contract lows last week and then have been trying to trade back and forth. But yesterday, a big day up and follow through today. So if you're looking to buy things from the U.S. while the dollar is cheaper, you might want to rush out there and buy more of it, you know, from another country while you're sitting at a lower exchange rate.
Yeah, we did this earlier, but there's the 6-month on the dollar. Wow, what a decline we've seen from back in February. And, you know, you could even take this back further than 6 months, and it's pretty impressive. But this shows what we've been dealing with over the past month. And to your point, the past week, this is what it looks like.
Yeah, it's been pretty interesting to see it come up, and we all know that that's going to impact our import-export markets. So,
all right, Chris, hang on. We'll come back and see if we can tie all this back into livestock markets as well. Market Day Report continues in a moment. So yesterday we saw some new highs in the cattle market. Can we expect that today? Well, let's start with live cattle futures. We're in the red to start the morning. 227.57, that's down 30 on the August contract. But notice that we're quite a ways off of the day's low, which was below that 227 level. October at 224.30, now 224.22, which is down 55 on our live quotes here. Feeders are off 22 at 333.30. September is really the leader here at 334.02, down 52. And then we go to the hog market, and hogs are lower. August down 67, 107.85, and that October now below $90. Let's bring back in Chris Swift, Swift Trading. You must have had a wild ride yesterday after that cattle on feed report on Friday.
It was pretty interesting. So I sat through and mulled through a lot of the numbers over the weekend. And the most interesting aspect that I came up with is we're only 1% less of cattle than we were last year. That's what the inventory report pretty much showed. And yet we still have great elasticity in price. I think it helps to form my opinion that there's still just about the same number of cattle out there available, but just fewer to the general public. Vertical integration, captured supply has taken a lot of that inventory, and we've noticed that all year long, since January, we've been trading just a little bit lower volumes of stockers and feeders all year. And then as we got April and May, the rains that we saw out there improved pasture condition, it improved hay growing conditions, and all of a sudden we wind up in June, we started holding back cattle, and there is a belief that that 4% that we missed on that cattle on feed report, the placement area there, is because we held them back. We kept them back for expansion, and that's where now we are, is we're probably starting at the very beginning of expansion. So year and a half from now, we'll start to have fresh inventory coming in.
Good points there. Let's look at the 6-month on the feeders. And I want to bring that up because this is still pretty impressive, not just the run up to where we are at the 330 level, but even if we were to just take the average in there up to 300, you know, that 270 to 300, if you've got producers who are coming in or really haven't seen the tough times, if you will, they're coming at some point. Would you agree?
Maybe, maybe not. I think it's going to be a little bit different this time than what people saw in 2014. Everybody kind of tries to mimic this as 2014, and there's a big difference. In 2014, we exponentially grew the cattle herd by holding back heifers and cows. This time, we scattered them out. We held back the cows and we sold the heifers. 2 years later, today, we're going to sell those old cows and we're going to start holding back heifers. So the big main agenda is always keeping beef production elevated. And that's what we have been doing. So now that maybe some of the aspects of beef production grown to the levels, we may not need as many cattle now and can actually put some of those cows back into the breeding and not cause too much more of an upset in beef production.
And at the end of that chain, though, is the consumer.
Absolutely.
And that's one we'll have to keep an eye on. Chris, great to see you
Always,
here.
Tony.
Chris Swift is with Swift Trading. All right, Suzanne.
Great information there. I know, great way to explain why we saw those placement numbers the way we did.
I think
Great
that's what
stuff.
it is.
Thank you both.